I'd like to start with our opening panel on headline views of industry, where we are in the mining cycle. I'd like to invite up Ethan Levine from Commonfund Capital, Caroline Donnelly from Denham Capital, Doug Groh from Tocqueville Asset Management, Philip Ho from Long State Investments, and Ian Mitchell from Gowling WLG. So please join me on the stage, ladies and gentlemen.
Thank you.
So these are certainly interesting times globally in terms of investment, and also when we look at commodities and when we look at mining. So I wanted to start by getting a little bit of an idea from where the investors and everyone on the panel thinks we are in the current mining investment cycle. I guess we can work our way down. Start with you, Ethan. What's your view? How are you seeing the markets at the moment?
Sure. I mean, I think over the past 6+ years, 7 years, I mean, we've been saying that there's going to be a rebound in the mining sector, and it's you've seen fits and starts of it, but we haven't seen that kind of broad rebound. And I think from a supply side, I think you can get your head around the fact that there's been a lack of investment there. There's been lack of projects coming online in a number of different commodities. But now we're facing a point where there's potentially a looming global recession, and so on the demand side, you have to wonder how that plays out. I think ultimately the fundamentals would support that we're kind of potentially closer to an inflection point to rebound more dramatically. But I think a lot of broad institutional investors are saying and looking around at a potential recession, and what kind of implications would that have for something like the mining sector, which could be directly impacted accordingly. And so there's a lot of uncertainty and a lot of hesitation, and I think that's kind of where we are right now in the sector.
You touched a little bit on the sort of institutional mindset. Could you delve into that a little bit more in terms of the investor money that you look after? And
Sure. So we manage money on behalf of a lot of endowments, foundations, other institutional investors across a broad private capital platform. And I think when I help manage our natural resources program, and I think when when investors have looked at natural resources, particularly over the past 5 years, as a broad sector, it's dramatically underperformed. And I think there's questioning by a lot of institutional investors as to, do I even need this exposure in my portfolio? And historically, it's been a good source of diversification, potential for an inflation hedge. And as long as there were returns that maybe came and go with time, people would allocate to it. But I think what we're seeing is a real pullback broadly in the natural resources space because there's a lack of conviction that it will rebound dramatically, and maybe I don't need this in my portfolio. And I think you've seen a flight of capital accordingly, which has only compounded the problem. And this is not just mining. This is also areas like oil and gas as well. And you layer in some of the environmental, social considerations that people have questioned. And I think one is performance is an excuse for the other, but it just contributes towards the lack of conviction and interest broadly in the sector. That's not to say there's no interest, but there's in aggregate that's definitely been the trend.
Yep. Okay, Caroline, what's your view on the sort of state of the market, state of the industry now?
Thank you, Adam. Good morning, everyone. So I'm Caroline Donnelly. I'm a managing director at Denham Capital. We are a private equity fund. We invest into 3 sectors: oil and gas, mining, and power and renewables. I'm solely involved on the mining side. And our modus operandi, which feeds into really how we think about the markets, is to look for management teams whom we can back with capital, preferably on a private basis, to bring projects through into production. So we're looking for assets which either can be built and turned into something that generates cash, or restarted to generate cash, or turned around to generate cash. So as you'll hear, we like the cash generation aspect of the business. And for us, we view the markets through that lens as to what is possible for the type of investing that we do. And we've been saying for the last couple of years that this is a very interesting entry point for investors and investors, such as ours and our limited partners who provide us with capital to get into the mining sphere. So, to Ethan's point, historically we've seen limited partners, the large endowments, foundations, public pension plans, being very interested in oil and gas. It's a market they well understand. They know how the business works. They can point to the 4 states in the US where most of the oil and gas investments are done. And that's it's a well-trodden path. For mining, that type of investing like we do, which is really a direct replica from the oil and gas private equity space, is more of a new situation to them. And this value dislocation between where the markets currently are and yet where producing assets and where companies that can actually generate cash are trading, that is very interesting for investors. So certainly natural resources as a whole, same as Ethan has seen, investors have pulled a lot of their money out of it. But what we've seen is that it tends to be investors don't want oil and gas exposure, but they are interested in mining, and it's kind of piqued their interest. And the question for a lot of investors is, how do I get involved? And of course, our answer, which is talking our own book, is you give us money and we'll invest it for you.
Yeah, but now is an opportune time as a lower entry point. Is that what your sort of overall view is?
Absolutely. So, when you look at where some of the juniors are trading at a 0.3 or 0.4 times their net present value, even if you look at some of the mid-tier miners who are trading at 0.6, 0.7 times their net present value, we can see those as great opportunity points to get in, invest more capital, hopefully, fingers crossed, prices improve a little bit and you can exit at a 0.8, 0.9 or 1 times net present value. So, we think about it in those terms. We also consider commodities, and perhaps we'll touch on this later. But to Ethan's point, we look at supply-demand fundamentals, as I think everybody does, and so some commodities are of far more interest to us than others, just given where the supply-demand dynamics appear to be playing out.
Okay, and you're very reactive to that, to those commodities in terms of their supply-demand.
I wouldn't say reactive. We tend to be long-term investors into our projects. So we will invest capital for 2 or 3 years in order to hold the projects for another 3 or 4 years and then have an exit. So, we need to see some supply-demand deficits either currently or, boding in the future that would allow us to put our money in for that longer term. Because we have very limited investment in the public space, we have no ability to get in and out, or very little ability to exit our positions. Though I would hazard a guess that in today's public markets, the ability to exit a position is not particularly good either. But it does mean that we're longer term investors, and so those supply-demand fundamentals that we look at, we need to see them holding for a longer period of time than just the next 3 months, as an example.
Okay, we'll come back and ask you about some of those preferences or views later. Doug, let's get your view on sort of the big picture.
I'm Doug Groh. I'm with Tocqueville Asset Management, and soon to join Sprott Inc. next year, early in the year, January. We invest in precious metal mining companies as our primary focus. So, my comments are really addressed to the precious metal space. And I think as far as gold goes, clearly the breakout this summer was notable. After 6 years of being held back, gold has finally stepped up and made a big launch into, I think, a new cycle. That's the way we're seeing it. What is it about this cycle, I think, that's maybe different or unique? What's interesting is that gold really led the equity performance in this cycle. Usually the equities start to move before the gold price does, but this time around we're really seeing the gold drag up the equities. And why is that? Why are the equities maybe reluctant? And if you look at your screen any given day when the gold price is moving up, you'll see, if you have gold mining stocks on your screen, you'll see a lot of red as well as green on your screen. And I think the market is very selective about where capital wants to go and participate in the gold cycle. And I think, to Carolyn's point, those with cash flow are really the more prominent performers in the marketplace, which is challenging then for those companies doing exploration and development. Basically, there is no market for them. There is no capital available unless you can find a particular sponsor, maybe a private equity group or a well-funded individual, Mr. Pierre Lassan or Mr. Eric Sprott, who's willing to perhaps prime the pump a little bit for equity, with equity for the exploration development space. And I think even in the projects that have good bankable studies, the capital there really is debt, which is also, I think, very unique here in this cycle as well, is that we're seeing the capital come into the space for projects is debt capital, with equity really being very reluctant. I think typically in the past, project financing would usually go through the maybe the steps of raising a little equity, finishing a study to refinement to a bankable feasibility study, maybe a little bit more equity, and then the debt capital would come on. Now it seems like there's sufficient debt capital available at really pretty high cost, 12, 15% cost of capital, but there isn't equity to follow up on that, which is, I think, rather interesting. I think investors have been certainly diluted in the last cycle. They're very reluctant to step in again. As Carolyn points out, it's not easy to get out. You can get in, but you can't get out. And I think it's rather great that the debt market is open to mining, because perhaps we're going to see a little bit of a different discipline bestowed on the mining companies. I think another point, and I mentioned this a year ago when we were here at the panel, is that the ESG development in the marketplace is very important, I think, for miners, for investors, environmental sustainability and governance. While it may not be a big focus, I think, for maybe individual investors, institutional investors are really looking at that criteria more closely, and it's becoming a defining aspect in terms of investment. So I think for investors, for issuers, you have to be aware of ESG and what that means for your company.
Yeah, certainly. I think we can come back onto the ESG point and how that's affecting both the way that companies work and the way that money coming into the sector has to behave. But Philip, do you have a quick view on where you think things are at the moment for mining in general?
Sure. First, a long-stay investment is a multifamily office. Money come from Asia, from primarily Singapore, Malaysia, and Hong Kong. Our investors are primarily real estate developers, so they are more interested in getting into a space, where they don't have much exposure to. So, they are not reluctant to invest in the mining sector and the resources sector. And as a matter of fact, they are very interested in getting into it, because that helps diversify the personal investments. In terms of the mining sector itself, we certainly live in a very interesting time at this moment. There are a lot of things going on. The trade war, between China and the U.S. As a matter of fact, globally per se, makes it very, very interesting. We see the Chinese economy not getting as strong as expected. Export, has decreased by 3% year over year in the last month in September. Import has decreased by 8%, which is much higher than what was expected at 5%. We talk about the U.S. election coming up, which is going to be a now uncertainty. I think all these things also help the gold price. Probably went up because of all these, uncertainties into the market. And then there are other things, the tensions, obviously in the Middle East right now between Iran and Saudi Arabia. We see a lot of other things going on into the market, that plays into this. So at this particular moment, it is a very interesting time to get into it. And I do echo Caroline in the fact that, it is a very interesting time to get in low and get into the market at this moment.
Interesting. Ian, have you got something to add across the sentiment that's been shared here, or what's the view from Gowling on the transaction side? How are you seeing things?
I think I'm the only non-investor here. So, but what I do is act for a lot of issuers, and the firm sort of globally acts for a lot of issuers, so we see the activity. And I sort of agree with a lot of what my colleagues have said, especially Caroline. I think we're seeing a real division in junior mining between companies who are either in production, have a brownfield project that maybe they could get back into production or with new technology could improve results, or are within spitting distance from production, because where we see people willing to put money in, even in this market, is where they have some line of sight to cash flow. obviously not with certainty, as Caroline said, but with some, better degree of certainty. Money for projects that are, further out than that don't have a feasibility study or maybe even a PFS is very hard to come by right now, absent sponsors. And it was interesting, sort of in the last downturn, some private equity got in to mining, obviously, and you saw a lot of funds build up positions. And for some of those funds, awkwardly large positions, especially if they were smaller funds, just to keep the companies afloat. And so we're also sort of seeing awkward positions now where theoretically people think the equity valuation should be better given, what should be perhaps an inflection point, given where we're at. But the macro sort of economics are holding that back. And so we're also seeing a bunch of companies where you have large investors with significant positions who don't necessarily want to put money in, but also can't get out without sort of killing their investment at the same time. It's sort of been really interesting from that point of view. So there is sort of debt available, I agree, but the only good thing that one of the only good things that came out of sort of the downturn in mining is we sort of got rid of a lot of projects and management teams that shouldn't have been in the industry probably to start with. And so you have a bunch of seasoned investors and people running companies, and I find them a lot less willing to take on any significant amounts of debt without having a sufficient equity cushion. And so I see people holding back on large capital projects or taking on large amounts of debt unless they know that they have that cushion, or they're far enough along, or they already have some cash flow, because far too many people were burned in taking on too much debt before, with commodity prices being as uncertain as they are. So I keep thinking everything's going to go up, and even when gold went up, it didn't sort of bring the bottom half of the market, by and large, didn't really do anything, at least in Canada. So my only bright light right now is that cannabis is taking a hit in Toronto right now, and so if that continues, hopefully that money flows back over to mining. But we'll see what happens.
So when the quick sparks filter down, people look at actually the real intrinsic value of gold or gold equities, and then rotate back in.
Yeah. Yeah, a lot of the investors are the same. Like, Toronto's not a big market. We have a lot of mining. The investors are very similar, and so we're seeing the exact same people. When mining went down, they moved. Some of them moved over to sort of tech and fintech and crypto, but a lot of that moved into cannabis. And now a lot of those people have made a lot of money, and a lot of those people got out at the right time. So there's a bunch of money there waiting, and I think if sort of mining fundamentals hold on, I'm hopeful that we'll see some of that capital flow back over to the mining side.
Okay. So difficult conditions prevailing, but actually lots of opportunity there. That's what I sense coming out in what we've covered so far. As investors, then, how do you play the market at present? Is this about commodity plays specifically, and then matching that with the right companies, the right teams? How do you go about your due diligence and making your investments at this point? Caroline, you had some points you were leading to before.
How much time do we have, Anna? Yeah, this could be a very lengthy
the top
discussion.
line stuff, and then
So top line is, we do look for commodities where we see good supply-demand fundamentals, as I spoke about earlier.
But
and we're,
can you say what some of those are now? Or
we're very keen in the base metal space. We certainly like copper. We're even putting some money into zinc. Can you believe it? Even though the zinc price has come off quite dramatically, we can see good supply deficits looming in the future, notwithstanding the demand constraints that Ethan mentioned. We will also take a look at speciality and more niche type metals where we can see a very compelling opportunity. So, these need to be fantastically high grade, preferably without too many issues towards getting permitted. So we will take a look at assets such as those. We haven't historically got involved in the gold sector, which I think differentiates us from a lot of the other funds out there. We found it typically to be quite expensive when you try and get in, and a truckload of competition. So, we prefer to get involved in things where we can get in cheaply, put our capital to work, and, hopefully exit in multiples of what we put in there. I will say I agree with both Charles and Doug on the debt side. We certainly are seeing a lot of debt available for companies. It's not cheap, but I suppose there's a debate to be had as to whether a 12% or 15% cost of capital for a mining venture is appropriate or not. Certainly my view is 5% is not. So, I think that's probably a lengthier discussion. But we're also seeing a lot of debt available in the markets, and companies looking around and certainly looking at us saying, well, where's the equity come from? As far as how do we play the markets, we've had a number of companies come to us and say, take us private, please, please take us private. The compliance costs, dealing with the exchanges, not that exchanges are particularly difficult, but just the costs that come into that, and the time spent on roadshows and marketing and investors, like, please, save us from this. The issue we typically face there, and I would put this out there for those of you in the audience, is value expectations are critical. It's no good coming to me and saying to me, Caroline, hamburgers are $2 each at McDonald's, but I've got this great hamburger and I want you to pay $8 for it because that's what I paid to get this hamburger. It's like, well, I'm sorry you paid $8 to get your hamburger. If hamburgers are scarce, I might pay you $3 for it. But I don't think your hamburger is that scarce that I'm going to pay you $8. So just think about that in the context of, well, my share price is 20 cents and I want you to pay $1 for it if we want to do a take private deal. So we've seen a lot more companies interested in going private, but the value expectations, I think, still need to be resolved.
Okay, interesting. Doug, what did you make of Caroline's point about gold being a bit expensive and competitive? Is that those are the conditions that you might thrive in as a precious metals portfolio manager?
What can I say about the gold price? It's cheap. I mean, you got to buy it now, right? We could spend more than a day, a week, or a month talking about the gold price. Look, the way I look at the gold price to characterize it, I think it is a barometer of financial anxiety. And so we can go down that discussion and that path. And so how anxious are you? If you're confident, well, then the gold price is too expensive. If you're concerned, maybe you ought to look at the gold price. If you're really anxious, the gold price is very cheap. So, I think it's a perspective that one has. And the purpose of gold that we advocate is that it is a diversifier in a portfolio, and the mining equities actually offer a little bit of a different element to that diversification. It's like a little bit of a high octane offset to the overall exposure that gold provides. But I think just coming back a little bit to where we are in this market, what characterizes this market, I think it's worth thinking about, and it maybe addresses a number of the comments and concerns here, is that this market seems to be more concerned about risk as opposed to return. And I think that would explain a lot of what the comments are here, is that sure, there's debt capital available at 12 or 15%. That's incorporating a lot of risk, where in the past the risk was not very, I think, well articulated or appreciated. But after the last 7 years, I think everybody's felt a good sweat of risk on their heads. So they're like, well, okay, yeah, I'm not going to look for the return here so much. I'm going to think about the risk first, and then I'll start to think about the return. And I think that's the reason why there's reluctant equity capital. There's other places in the world where they can get attractive return for a different element of risk. I think that investors currently are much more sophisticated than they were 15, 20 years ago. Certainly the information is more available, analysis is more easily done, the comps are more accessible. So I think people have a better understanding about what the opportunity is, and they also have a better recognition of the risks. So that's something I think is a little bit different in this environment than we've seen in the past.
Okay, Stanley. Anyone else on the risk? Philip, how do you look for return in this current market then?
Sure. First, I just want to respond to one point that Caroline mentioned about, which is companies trying to go private. We see a lot of those companies coming to us as well, especially junior mining companies. Many of them, do see that, the equity market at this point, offer them very little opportunity to raise capital in the market. And together with the compliance, together with the cost of being listed, they just don't see much value of being listed at this time. So, to the extent that it's possible, they do want to find another avenue for them to be able to, find a way to, get the project funded. So, it is, something that we do see in the market as well from our side. Very similar to other panelists mentioned about, we do look at, the fundamentals of the market. We look at, companies by itself, the projects, to see, what may be appropriate for us to invest in. The typical things that you would expect, the size, of deposit, the grade, being a low-cost producer, the ability for you to get financing, for the project to be financed. That means CapEx cannot be too high. All these different things are very important in our decision-making process. In terms of commodities, I do agree with Caroline again that I do believe that copper is a very good one right now. We look at some of the data out there with the Chinese demand for copper. Run rate is about 25 MTPA at this moment, but they are not able to secure sufficient concentrate at this particular moment. So on a year-to-year basis, the copper concentrate demand from China is actually much higher, than what is being able to supply. So, in terms of copper, in terms of commodities, we do like copper. We also like nickel a lot. I think there are a lot of data out there, that sees the cancel warrant, number being extremely high at this time. 56%, if I remember correctly, as of last Friday, that demonstrate that even at this high price, 750, there are a lot of support, for nickel. So, so we do like that, and being, someone who likes, buying cheap as well, I do believe that all the battery minerals, right now, extremely cheap at this time. Long-term demand will be there. The EV numbers in China, production and consumption in the last month is not good because of the government subsidies gone. But then in the long run, talking about like 2, 3, 4 years from now, it will come back. Power storage will come back. So lithium, graphite, cobalt, these are the sectors that we do like with good companies on a fundamental basis.
And how are you determining those good companies? I mean, there's a lot of companies out there, a lot of lithium explorers out there. So what's your due diligence within those commodity sectors? So,
once again, the most important thing is to look at, the ability for you to finance the company in terms of CapEx itself, not being too high, and also OpEx. Ongoing OpEx is very important. Right now, you're talking about, lithium carbonate prices being 8,000 change. If you are not a low-cost producer, you won't be able to survive. So, being low-cost producer is very important.
Ethan, you look across the commodity sector. Do you have the same sentiment for copper? Is nickel interesting, or do you looking at gold?
Yeah, I would just say, like, an aggregate, to kind of echo Doug's point regarding risk. I mean, yeah, people are focused on risk, and that's because you don't need to take higher risk in this kind of environment. I mean, everybody's said already that the entry point is so attractive. So why take extra risk? So I mean, our approach as it relates to which commodity, relates to which geography, what kind of stage, it's all about trying to say, like, let's try to mitigate some of these risks. I mean, when it comes to which commodity, we would prefer more liquid kind of commodities like copper, like the base metals, because one of the biggest risks in any kind of mining project is the ultimate commodity price, and if there's so much volatility in that price that you're just incurring risk that you otherwise don't need to. The geography, I mean, we don't need to go into jurisdictions that are less desirable from a permitting standpoint. And stage, we don't need to take exploration risk to generate strong risk-adjusted returns. You can go later stage. So a lot of it is about mitigating some of these risks, and frankly, that's because of where we are in the cycle. It's one can do that and generate attractive financial risk-adjusted returns.
Okay. Yep.
Yeah, I'd just like to add on to what Ethan said here. I think what strikes me about this market, and this has been this way for a number of years, it's very interesting when you talk to management teams of exploration companies that you ask, well, how do you see this panning out over time? And often the management teams are unable to give you an answer. So, the question is often raised, well, if I'm in exploration and everybody wants to do later stage projects, how do I get any money to do the exploration? And certainly for us at Denham, we really struggle when a management team is unable to articulate how they plan to get from where they are today, raising $5 million, to something which could be a saleable asset. And we appreciate that there's an immense amount of risk involved in exploration, that you're subject to the vagaries of the market, that you have all the other headwinds against you when you're in exploration. But if the management team who is involved day to day with the project cannot articulate from today a path forward to an asset which could potentially be saleable in the future or be able to be built in the future, as an investor, that makes it extremely difficult for us to try and figure that out. So I would put that out there to the corporates in the room. Take a big step back, look at your projects, and if you can figure out some sort of a path, even if it does seem a bit pie in the sky, that would make it so much easier for your investors to attempt to invest when they can see that you've thought about what the strategy is for the future for your project.
We do hear a fair bit from a lot of the juniors around the supply and demand long run. If they're in battery metals, they talk up the EV game quite a lot. But you're after something far more specific and concise around, rather than just going with some sort of industry narrative you want.
Yes, absolutely. Something specific to the project that they have, where it is, And I understand that in terms of all the exchanges, you can't put out numbers around CapEx. You can't, you can barely do anything until you've actually got something which is a signed-off report. But there's, some sort of rough, thumbsuck numbers would be helpful of, okay, well, we have this asset, and if it works out as we think, it's going to take X number of dollars to get to a pre-fees, X number of dollars to a bankable, then, Y number of dollars to build it. And then that allows the investor to sit back and try and figure out, well, if I do invest today, first of all, where is this other capital coming from? And how do I make sure that I don't land up in the position that I think it was Ian mentioned, where the funds keep pouring money and keep pouring money in to keep companies afloat. And our approach tends to be quite different in that when we get into projects, we set aside sufficient capital to make sure that those projects are fully funded to a point where we think we can exit. So we try and take that risk off the table on day one, so that our management teams aren't looking around going, where's my next $5 million coming from? They know if the project is panning out the way as expected and the results are coming out as planned, that the capital is available.
I mean, just to put it in a different context, same thing. I mean, I think the junior mining market grew based upon more of a desire for speculation. And I just think investors are not going to invest based upon theses that are surround speculation. So when the EV market will hit an inflection point, when batteries become more cost competitive, I mean, that could happen in 2 years, it could happen in 10 years, but it's based upon the speculative macro kind of trend, and I think it has to relate more to fundamentals, to Caroline's point, how you're going to finance these projects, because frankly, speculators, they're not focused. Ian's point, they're on cannabis and crypto, and they haven't come back. I don't know if they will, and so it has to be based more upon the project fundamentals than pure speculation.
Yeah, and I would just say, obviously, we have the professional investors here. The other part of the market is retail, and there's been a complete lack of liquidity, at least in a lot of junior mining stocks. And I just think it comes back to the expectation of a more immediate return. And I think the market has been more hesitant to record sort of intermediate successes, so shall we call them, for mining companies who get a couple decent results in maybe 6 years ago that would have resulted in sort of a more immediate return on the stock. And I think investors on the retail side also need to start, adjust their expectations a little bit, that these are more sort of long-term plays, the way the professional investors are looking at them. And you're just not seeing that happen very quickly either, because they've had other places to go. And so, for so long as there continues another place to go to get a more immediate return, that liquidity is going to, continue to be a problem, I think.
Okay. I'd like to open up to the floor now if anyone's got any questions. We've got a microphone going around. Someone down here? Yeah, let's start here. Yeah, sorry, 1 second.
Everybody can probably hear me.
Well, it's
anyway.
for the camera.
I just wanted to comment on something that Douglas said, because as chairman of a gold mining company, I'm always getting asked about the gold price. And my answer always is that gold doesn't have a price. Gold has an exchange rate, because gold's only function is money. in reality, oh, sure, there's a little bit of jewelry demand and such, but it's basically it's a monetary asset. It's a monetary asset that isn't issued by any government. So when you say, well, what's the gold price? I would say, well, what's the exchange rate today versus the yen or the dollar or the euro or the Brazilian real? Because the reality is it may be going one direction against the US dollar while it's going another direction against other currencies. It trades in the currency market as a monetary instrument. It doesn't have a price per se. It has an exchange rate.
I think that's a good point. It's not a commodity.
Yep. Everyone in agreement? Yeah. Okay. Any other questions? There's one at the back here. Sorry.
Thank you. Several people have mentioned that there's a lack of interest in junior equity. Where have these? I look around here and I see some of us are over 50 in this room, and where are the young speculators, and why aren't they around and investing in these shares? They used to.
Well, I think they pursued crypto and cannabis and some of the, FITech and other innovative ideas in the marketplace where, this was a speculative sector, going way back where, and an international sector at that. So there was an element of speculation with regard to the international dynamics. But now with the, globalization, there's so many different opportunities around the world and access to different opportunities. I think youthful minds are pursuing those type of new innovative concepts.
And I would add to that, a number of people on the panel have mentioned ESG concerns. It's not as though the mining sector has frankly covered itself in glory on the environmental side. We've had three tailings dam spills in very recent history. I think perhaps the folks that are younger than me, of which unfortunately there are a lot these days, are very interested in the environmental side of the business. I think if we, on the whole, as the mining sector, can do better around the environmental side, specifically around things like battery metals related, renewable power related, etc., I think that might bring investors back into the market. We have our annual general meeting around this time of year, and it's always quite surprising to a number of our investors just how much metallurgical coal is needed for a wind turbine. And it's something like 63 tons of met coal is needed for a wind turbine. You need rare earths for the magnets for wind turbines. You need 16, 17 rare earths, don't quote me, for your smartphone. And these are things which I don't think the younger generations really understand. And these are stats that really need to get out into the market, and people need to explain where the stuff comes from. There's this sort of misconception that, it grows on trees. But, so much of what goes into renewable power, electric vehicles, is actually mined. And if we can do a much better job as the mining industry on our environmental side, and I mean that just broad brushstrokes as a whole, not to individuals in this room, I think that might attract more investors into the space who are, younger than those of us here.
So it's very much that ESG narrative, and maybe not just an image issue, but the educational piece that's got to change that image, because it's not going to happen just by pushing back on the likes of Greta Thunberg and characters like this who are very anti-extractives, let's say. Ian, you have something to say on that?
Yeah, no, I was just going to agree. First, I was going to say agree. Cannabis and fintech. For the first couple of, for the first year of cannabis, I don't think I met a CEO over the age of 26. I think that's changed dramatically now, but it is the complement from an age perspective in fintech, crypto, cannabis is what sort of mining looked like 20 years ago, I think. And that's, I think, just a view that it's exciting, it's new, it's a new frontier, it's something they feel they understand better than perhaps prior generations, and so they feel comfortable with it. But I agree, we were talking earlier, and I agree entirely sort of on the educational component, on the environmental front. Obviously, mining companies need to deal with environmental issues. I don't think, in my experience, that I've ever met a mining company that doesn't want to do that. I think there are, at least on the North American and European side, a lot of good people wanting to make sure that they do what they need to do for the environment. But I do think the marketing of mining as a general proposition needs some improvement, because it doesn't sort of have sort of a global view that it's contributing to the new economy. It's very much viewed as, I think, an old world economy which is not accurate. All the big car companies are scrambling to make sure they line up enough components so they could have batteries if they need them. People know they're running out of batteries, or running out of the metals that are needed for those batteries. Cell phones, if there's gold in cell phones. And sort of all of those technologies have components that come from mining, and mining has done a very, very poor job sort of selling itself as part of the new economy. And I'm not sure how we switch that narrative, but it definitely needs to be done, because you have this conversation all the time. And I was having with a younger guy at a junior producing company, and he does their ESG stuff, and he's going on about all this stuff, and I'm like, but have you considered that without this, you don't have all of these other things that you're pointing out as some of the benefits of the new technology? And it just, for some reason, the connection isn't getting made between, we want all of these new technologies, we want all of these products, but somehow, the starting point for those is bad, and we can't fix that. And I think that's a big narrative that the industry as a whole needs to work on.
And I just want to talk about on the engineering side, further downstream from mining, there are a lot of companies working very hard to try to reduce the carbon footprint, reduce the use of toxic materials, cyanide and leaching. There are companies working on removing HF in the purification of graphite. All these things really help to improve on the environmental impact itself in terms of getting the end product to the end users. And I think the mining industry, together with the industrial partners, need to really get this message out to make sure that the end users understand it, and also the buyers themselves, the trading houses, they a lot of them do put those kind of requirements into their purchase itself.
Any other questions for the panel? We've got a couple of minutes left.
Yeah, just quickly, given what you've just been saying, this might be a controversial, not very political topic to bring up, but what's your view on the outlook for nuclear power?
Uranium bulls, anyway?
I mean, here in the United States, I don't think the outlook is particularly good. I do think it looks better, potentially in other geographies, places like China, where I think there's potentially more social acceptance of distributed nuclear power, modular nuclear power. But I think here in the U.S., while there are some instances of new nuclear being built, I just think on the cultural side, it's going to be a challenge, and I think that's going to be the case in a lot of other jurisdictions as well. That's more just a personal point of view.
I think as far as the energy narrative, renewables and the battery market is still very much in the fore, whereas the nuclear alternative, which I think is very compelling, is not really on people's mind. I think that has been addressed in the last 50 years, and I think worked through, and I think the battery market and renewables, wind or water or what have you, is really taking a front view on where energy is coming from. So I think as long as that still has an opportunity for investors, nuclear probably really sits on the backside of people's minds.
Although I will just add quickly, at PDAC, our firm had an event with a Canadian company that's developing modular nuclear reactors for mining projects or for large projects in remote jurisdictions. I think there's a Canadian company, there's also a Russian company, perhaps not surprisingly. And it was extremely well attended, and there was a lot of interest, because for something smaller than sort of a train car, you could basically power the entire project, the related community, and sort of everything around it. And so it was extremely well attended. Obviously, there are a host of political and other issues that I'm sure would go into moving that into any jurisdiction. But there was a lot of interest in trying to find solutions for projects that draw a lot of power in areas that don't necessarily have the infrastructure for it. So I thought that was an interesting sort of take on it as well.
Okay. We've got a minute left. Is there a message, an overall message that we could quickly send to all the miners in the room here that would come from you in terms of what they should be focusing on heading into 2020? Just if you've got one thing, whether it's continuing with good, tight cost discipline, looking at investing for growth.
Yeah, similar to what we've discussed, I'd say a focus on generating cash. I mean, because that has been lacking in the sector, and I think that ultimately will draw more investment.
And for me, it's, if you're not close to generating cash, which obviously we like the cash generation aspects of the business, but if you're not there, please sit down and figure out what your plan could potentially look like to get to a point where you're generating cash, even if it is 5 years out. Have that well laid out in your mind so that if an investor asks, you know what it is you need to do.
A repetition of a message is a well-delivered message, perhaps better received too, and that is be thoughtful about what you're doing. I think to Carolyn's point, think about the strategy over long term, not just because the markets are up, is it a good day to raise capital, but how are you going to use that capital longer term to be around to raise capital again in the future. And I think being thoughtful over the long term is appropriate for seeking capital that is also thinking long term. So,
I agree with the other panelists on this. Very important, for the companies to be able to identify as to what the cash need is going to be for them, to get to the milestones of achieving cash flow. That's very important. And how exactly do you get there, and how much money that you need to spend? That's allocation of resources is very important.
I think all that's true. The only thing I would add to that is, and someone mentioned it earlier, I think companies need to be realistic given what the current market is. So both when you're developing how much cash you think you need, and then looking at the market and reflecting what price you think you're gonna get it at and what that dilution looks like, I think issuers in this market need to be fairly realistic. I've seen a lot of mismatch expectations between what people are willing to put money in at and what companies are willing to take. Usually that results in the company not taking the money, and then 6 months down the road, you're back at the table again, possibly in a worse position. And so I know it's not good news, but I think being realistic and taking what you can get in the short term, as long as you have a good use for it, is always a good thing in my view.
Okay, fantastic. There we have it. Difficult times, but plenty of opportunities and value out there. Let's have a round of applause for our panelists. Thank you.